Hi, I'm Professor Congleton. This is Econ 201 Honors Principles from West Virginia University. This is a lecture on time at first. That is the effort to kind of calculate present discounted values. And towards the end of the lecture, we'll talk about how to combine expected present value or present values and expected value calculations using formulas from the previous chapter to think about risky long-term investments and how to combine those two ideas to make kind of sensible or rational or internally consistent choices. Okay, I've got the whiteboard covered with numbers. Those numbers took me quite a while to program and get a spreadsheet to develop for me. And what I'm going to do first is just kind of start off with a particular formula. This turns out to be a quite useful formula, and if you were to purchase or look at a financial calculator, this would be one of the formulas built into it. Okay, in this course, you're going to have to kind of punch the numbers in by hand, I guess. So if you own a calculator, that's fine, or if you have an app on your phone that serves as a calculator, that's also fine. You can use this formula either way. So the way to think about this lecture is there's a block of material at the top, a block of material here, a block of material here, and then there's another one I'll create after we get through discussing this part. So the formula we're going to look at is this one, okay? And that formula is the present value of a steady state stream of values into the future. And those values could be benefits, or they could be costs, revenues or costs, profits, any type of time stream that occurs periodically. Okay, I'm assuming these are annual flows, and that means that when we do present values, we want to look at the annual rate of interest to do so. Okay, so V is the annual amount. And in this case, we're assuming that the annual amounts are exactly the same amount, the same value every single time. Okay, if you remember from the tail end of the last lecture, I put up a kind of example where you've got $100, 1 year from now, and then 2 years from now, and then 3 years from now. And I kind of I wrote down the additive version of this formula. And I did kind of some rough calculations, and I said that it would come out to be roughly $250 in present value terms if the interest rate is 10%. Okay, so R is again the interest rate, and T is the time period. Okay, in this case, T is not like the endpoint, although in a sense it is. It's the number of times you get the payment over the course of time that ends in period T. All right, so you're getting the same value every single period. In this case, like that last example we did in the previous lecture, where you've got 100, in 1 year, and then in 2 years, and then 3 years. Instead of using the additive formula, we're going to use this fairly ugly-looking formula, which turns out not to be that hard to punch into a calculator or use a calculator app to compute. And so that's why I think it's reasonable. If I've got time and I'm doing more than one calculation, I normally set a spreadsheet up to do this because it's just easier to have the thing programmed and kind of run out the numbers. And you'll see I've got a sheet here, which you probably can't read the numbers of. Maybe I'll stick it over here closer to it. And you can see that those are columns of various numbers, similar to what I've got on the board. Basically, I've just copied them off this result from the spreadsheet program to the board, at least a subset of the numbers. Okay, so if we wanted to use this formula instead of the additive formula for the problem that we looked at the end of the last lecture, which is just 3 identical payments of $100 in 1 year, $100 in 2 years, $100 in 3 years, more or less like a rent almost. In this formula, instead of that formula we used last time, which is just the summation formula, and I should say that formula always works Right? You don't have to use this formula to do these kind of intertemporal calculations where when you get the same amount every month. Okay, you can use the additive formula all the time. It always works. However, if you're doing more than about 3 periods, this formula is a lot faster. Okay, for 3 periods, it's kind of a toss-up. Okay, but let's see how you substitute the values from that last exercise into this formula. All right, so V, the amount you get every period, was 100, right, in the previous case, the one we looked at last time. Okay, and T was, in this case, 3, right? You get, it's 3 years out, there are 3 payments, okay? And the interest rate was 10%, which we wrote as a fraction, 0.10. So if we take all those parameters and we substitute them into this formula, we get 100, that's the V, and we get 1.1 to the 3, that's the 1 plus r to the t, right? T is 3, the interest rate is 0.1, because it's 10%. So 1.1 to the 3, then minus 1, okay? And then that term is divided by 0.1, the interest rate, times 1 plus the interest rate raised to the t power, which is 1.1 to the third. And when you punch those numbers into a calculator or run them on a spreadsheet, you'll get back $248.69 and some other numbers if you carry it forward to in more digits. But since our currency only goes to 2 digits, that's plenty for characterizing the result. Notice the ballpark number I gave you, just working the numbers in my head and kind of rounding off a lot. That was actually pretty close. I was actually surprised to find how close it was when I had the spreadsheet turn the crank on it instead of me kind of ballparking it based on intuitive arithmetic relationships. And if you had done the additive formula and you'd done it precisely, done it with a calculator or with a spreadsheet, you would have got the same number, right? So this particular formula characterizes the results out of that additive formula whenever the values you're adding up, the values that arise every date in the future are exactly the same number. Okay, and it turns out that there are lots of things like that, like when you write car payments or make mortgage payments, the V's are all basically the same. Okay, the period is determined by the terms of the loan, and the interest rate is also determined by the loan instruments. And if you were a bank and you wanted to sell your loan, your car loan to some other bank, they would look at the cash flow generated by that loan, which would be more or less something that would fit into this formula. And they might use a different interest rate than the interest rate on your loan, maybe a little higher interest rate to account for the risk of default. And they would calculate the present value of that loan, and they would say, okay, that's what it's worth to me. That's the most I would pay for it if I were buying it from another bank or some other kind of financial firm. Okay, so in terms of business practices, this type of calculation gets used in a lot of finance settings. It also gets used if you're thinking about investing in a piece of equipment, right? So you have a piece of equipment you're thinking about buying. You expect it to increase your output by a certain amount each year. You think the price of that output will be some particular value. And so you can compute the extra revenue generated by that particular machine every year. And then you can go through the same process and figure out what the present value of the machine is in terms of its increase in revenues for the firm. And if you can buy it for less than that, then it's a good deal, right? You're going to earn a rate of return higher than the interest rate. And the present value of your revenues will be greater than your present value of your costs. So there are lots of applications of this. There are some applications in the web notes that go with this lecture series. And I decided to come up with a couple of different ones based on a choice that you're presently making, which is to say your decision to pursue a 4-year college degree. I'm going to take the spreadsheet that I worked out and add that to the lecture notes as an appendix. So if you want to see additional calculations you can just turn to that appendix. I haven't done that yet. It will be done before you look at this lecture, I imagine. And so if you want to take another look at the lecture notes or the appendix to see a few more calculations, go ahead. I think it's useful. And for the most part, I'm just going to tell you the answers to these calculations. So if you want to test your ability to substitute into the formula and get the right answers, you can use these numbers to kind of test yourself and make sure that you've got the mechanics of entering the numbers into your phone's calculator app properly. Sometimes that's a little tricky because the order of calculations varies a little bit by the calculator or the calculator app that you use. Okay, so this part just shows you that the calculations we did last time using the summation formula, work using this formula. And I have to say for 3, it's not clear that it's any easier than just doing the addition. However, if you think of something that goes on, say, for 40 terms or something like that, every time you do one of those divisions, you got to put the term in, you got to divide, you got to do the exponential division. You've got 5 or 6 operations every time you add one thing to the series. And if you're doing this for, say, 40 times, that's about 200 operations, and you're bound to make 10 mistakes, along the way, and not get a very precise answer if you use the addition method, okay, on a hand calculator. If you program a computer to do it or set up a spreadsheet to do it, that should work okay. But on a spreadsheet, it just takes a lot of space, and a lot of times you don't want to waste all that space to do one type of calculation, and so this formula winds up being a very useful shortcut. In the web notes, I show how you can derive this formula from the addition rule, and so you know that this is exact. Okay, it's not an approximation. It's just another way. It follows just from the algebraic properties of the addition formula. Okay, it's not intuitively obvious that it would do so, and I'm not holding you to being able to derive it on the exam. But for people interested, you can go to the web notes and look for the derivation. It doesn't take very long. It's just a half a page or something like that. So in the bottom part of this whiteboard, I have added some numbers from that spreadsheet I showed you a second ago to give you a sense of the rate of return from a college education. Okay, and I took an example where the extra income, which I'm going to call, which is my V in this case, that is generated by a 4-year college degree, and it will vary by degree. I'm assuming you're going to take a serious degree like an engineering degree or one of the business school degrees or an IT degree, okay, in which case these numbers are pretty reasonable. If you take a degree that isn't by itself much valued by markets, I don't know, say medieval history or medieval poetry or something of that sort, the returns will be lower. Financially, it could be that you enjoy that type of work a lot, and and you can use this type of calculation to figure out the money equivalent of how much your enjoyment is costing you in terms of other income that you might be earning with a different kind of degree. Okay, so part of what I'm interested in is a relationship that I talked about last time, that the higher the interest rate is, the less important future amounts are. The less future amounts contribute to the present value of a time stream. And I'm doing 2 interest rates in this calculation. One is 5%, one is 2.5%. So 5% is a little lower than you can manage these days on mortgages, say. Although a few years ago, before we had this inflation uptick, associated with some of the fairly extravagant COVID expenditures and increase in the money supply, a couple of years ago, interest rates of 2.5% were not uncommon for mortgages. Okay, so I decided to use those 2 rates, assuming that the mortgage rates will kind of head back down towards 5% in the not too distant future. And so that's a kind of reasonable number to use at this point. And it could be that they'll go all the way back to those really low and almost too low rates that were around a few years ago, certainly in the pre-COVID period. Okay, so I'm assuming that you get $20,000 per year extra, right? So that's my V. I'm assuming the interest rate is 5%, so that's the 1.05. Okay. And T, I'm going to assume that your career lasts 40 years. All right, so you enter college when you're roughly 18, you get out when you're 22, you work 40 years, that's 62, that's the early retirement age. Not all of you will do that. Retire at age 62, and some of you will do something, have really bad luck and not make it to 62. But most of you will make it to 62 and make a decision about, okay, do I want to keep doing this or not? And whether you want to keep doing it or not is probably at that point either a financial issue or something about your own preferences. You may actually enjoy your work and not feel like giving it up, and having a life of leisure, which kind of vaguely resembles your college, well, you say your high school summer breaks before you start working all the time in the summer. Okay, so I'm just going to do substitutions. I've got the 20K for years V. I've got 40 for my lifetime income, and the interest rate is 5%. Okay, that's the first line. So if I plug it directly into the formula, I put the 20,000 in for V, I put the 5% in for R, I put 40 in for the T, and I just plug all those numbers into the formula, and out the other end comes the number $343,181.73. Okay. So remember last time I said that sometimes it's kind of hard to do these because the interest rates are moving around and so forth, or inflation and other kinds of risks. Okay, so this is kind of a ballpark number that you can kind of use. Okay, I wouldn't say that if all this went through and in terms of the career path you chose, that's exactly what the present value of your lifetime extra income would look like. But it's in the ballpark. Okay, pretty and not crazy, and it's calculated in a way that's kind of forward-looking and thoughtful. Now notice that you don't actually get that income right away, right? You have to wait 4 years if you're a freshman. And that means that that amount should be discounted back a little bit, because that's the present value of that income stream as it will feel 4 years from now when your career starts, after you get your first job and start earning income based on that degree. And so that number really should be discounted back another 4 years. And if you take the formula we used last time, the F4 divided by 1 plus R to the fourth, and use the 5% interest rate for that calculation, then you get a smaller number. You get $282,336.46. And that would be the present value of the income stream that you'll associate with your degree when you start college. Okay, so if you get through college, get a degree like this, your lifetime income in terms of present value will increase by over $250,000. Okay. The other thing you might want to think about, if you're in net benefit maximizing mode, is, okay, what's the cost? I mean, there's tuition costs, there's housing costs, eating costs while you're at the university. It's 4 years of that. I looked up the costs for in-state students and out-of-state students at WVU. The present value of your tuition and housing from WVU, if the interest rate is 5%, is $85,000 per year. So for $85,000, you're getting back $282,000. So that, basically you're getting back roughly 3 times, a little more than 3 times your investment. So that's an excellent rate of return. There aren't really many investments that can reliably deliver such a return. And of course, that's why a lot of people go to college, even though they've actually never done anything like these present value calculations. They just have the intuition that college is going to pay. Well, as I said earlier, that depends on the degree that you choose. If you choose a degree that has a relatively low premium in the market afterwards, then the return will be lower. Okay, and there are cases where people, pick a degree that has so little value in the market that they wind up, basically earning roughly what they would have gotten without the college degree, but hopefully being happier people. Otherwise, they've really screwed up in terms of their calculations. Now, the other thing you might mention is, or I might mention, is that when you have your economics hat on, you know that the cost of the college education isn't just the tuition and room and board fees at the college. There's also your opportunity costs, right? So you could go out and earn an income for those 4 years that you're in college, you know, working a normal 40-hour-a-week job of some sort, of the type that a high school graduate could get. So as an approximation for that, I just assumed that the wages were $15 an hour, which is, you know, $600 a week before taxes. And I'm ignoring taxes. And if you look at that cost at the discount rate of 5%, it's $106,000 and change. So the opportunity cost is actually higher than the tuition. And you add the two together, and you would get a little less than $200,000 as the cost of your degree. So that makes the returns smaller, right? So it's, you know, you're paying $200,000 to get $280,000 in this scenario. And so the rate of return on that investment, still not bad. It's about 40%. And again, there aren't very many safe investments that you can make that would return 40%, but it's not like, oh my, this is a terrific value. Okay. Now, the other thing to keep in mind is that the salary differences vary by, your skill set and your degree, and also what you do with a degree. And many people's premium is more like $40,000 a year than like $20,000. Okay, and so if you're in that category, you know, these two numbers would be doubled, and you'd be looking at so over a $500,000 return instead of a $280,000 return, and that would get you a much nicer looking rate of return of, you know, more than doubling your investment, doubling your opportunity cost. And again, this is in present value terms, and not counting any difference in job satisfaction. Right, that part is hard. You know, it's up to you. Everybody has a different sense of what kind of the level of satisfaction that associated with different kinds of jobs and career paths look like, and that subjective part isn't being captured in these numbers. Okay, so based on this type of calculation, it's clear that college pays. Okay, has positive net benefits, and it's worth it. As long as the premium is, non-trivial. If this were only half as big, you know, if it were only $10,000 a year, and you were mainly doing it for the financial return, then looking at the other costs, the $190,000 versus $140,000 over here, if you had only half the V, that's the number you would get. It would not be a very good return, at least not financially. It would have to be made up for with some subjective benefits, either for the fun of attending college or the more satisfying career afterwards, even if it didn't pay much financially. Okay. So this is how you do net benefit calculations when there's a significant time element that you want to think about, and one that takes account of the opportunity cost of your money being tied up in your education. Now, I said in the previous lecture that discount rates matter. So what the interest rate is makes a big difference in terms of these sorts of numbers. And in particular, if your discount rate is lower, the value of these future amounts coming in the distant future, 40 years out, they become larger and more significant. And that means the present value of the whole time stream tends to go up. Okay, so these are the same numbers with the discount rate of 2.5% instead of 5%. So again, I'm just substituting into the formulas. The only thing that differs is the places where R shows up, over here and over here, so the three places where the interest rate influences the result of the equation. And in that case, you get a present value of that's almost twice as large for that series by itself, ignoring the fact that it doesn't start for 4 years. And when you take account of the fact that it starts after 4 years, so you plug that into the other formula, F4 divided by 1 plus R to the fourth, and gives you the present value in today's term as a freshman before you get too far into your college education. So the returns look better when the discount rate's lower, and when the interest rate is lower that you use in the present value formulas. So another way to think about it is that the higher your discount rate is, the higher the interest rate is, the lower the weights are that are placed on these future amounts. And so some of these other numbers that are more short-run types of costs, they become relatively more important. So if you had a really high discount rate, it could also be the case that even if you got a $20,000 per year premium, that because it's so highly discounted and the costs are kind of front-end loaded, right? You get those right away in the first 4 years. That for a person with a really high discount rate, college degree like this one wouldn't necessarily pay. The returns would have to be higher, and they are in many cases. Okay, so this is one application of using this present value type of approach to thinking about net benefits. You can use the same type of calculation, as I said before, for all kinds of investment decisions you might make, including purchase of a rental house or a house for yourself, or purchasing some kind of bond or other type of asset in the stock market. Again, you can think about what the returns are relative to the opportunity costs and make decisions that are consistent. Now, I wouldn't expect you to pull out your calculator and make a calculation like this every time you make an investment. But if you buy like a rental house at some point in your life, this type of calculation makes complete sense. There was an example of a local bookstore when I was in college called Books, Strings, and Things. And it's quite an attractive store, and it was back in the days before Amazon, where bookstores were relatively common, and they were just filled with just shelf after shelf of books. And it's really kind of a neat place to go if you like books. And the owner's accountant at some point pointed out to him that if you did the present value calculations of the money coming out of the bookstore, that it was actually a pretty lousy investment, even though it looked like quite a successful business just as a customer. And after his accountant's advice, he closed the store. At least that was the story we were all told. So there are instances where even a business that has positive cash flow, but the cash flow is below the opportunity cost rate of return that they can make on the assets they have tied up there, will lead people to shift their money into that higher return use of their money. So it has direct practical effects on the way a lot of businesses make decisions. And therefore, it affects the types of supply curves you see in many markets, certainly markets where time is an important element in the investments. Okay, I've worked out some other numbers that will show up in the appendix when I add the spreadsheet to the lecture notes. But I thought I would show you how you can combine the two methods. That is, the methods from the previous chapter on expected values and the measures here for present values. So I want to look at expected present values. And the idea is that if you remember the expected value formula, So the main thing that happens when you use expected present values instead of just expected values is the V's become expected values, right? Or the present values, right? So you got to do your discounting on V. Okay, so what I'm going to do is an exercise just to kind of illustrate this and kind of wrap up this section as far as the recorded lecture is concerned, is to think about a lottery. Okay, so the lottery has a prize of $50,000 per year for 20 years. And the probability of winning is 1 in a million. And the cost of the ticket is $1. And we'll just assume that the interest rate is 5%. I think that's what I did. I just want to double check here. Okay, now my numbers. So if we substitute those back into the formula, the value of the prize equals 50,000 times 1.05 to the 20th minus 1 divided by 0.05 times 1.05 to the 20th. And that number is $623,110.52. Okay, so it's quite a bit less than a million, right? So 20 times 50,000 would have been a million. And because of the discounting, it's about a third less than that in terms of its present value. So now we wanted to figure out the expected value. It's going to be that 1 in a million times the 623,110. Left the 10 off. 52 minus the cost of the ticket, $1, plus 999,999 over a million times minus 1, the cost of the ticket. And when you do all that work, you get back minus 0.377, right? The present value of the ticket, the whole bet, the bet counting the cost of the ticket is less than zero, right? It's basically it's a negative 38 cents. And that's because the present value of the prize is less than the cost of the ticket, right? The present value of the prize is basically is basically 62 cents. The ticket costs $1, okay? So the expected benefit is lower than the expected costs, and when you subtract the cost from the expected benefit, you get this minus 38 cents. Right? And it turns out that most lotteries have that kind of property, that the expected value of the lottery ticket is almost always less than zero, unless it's some kind of charitable event and there's a big sponsor that somehow is going to be overly generous with the prize relative to the cost of the tickets. That's pretty rare because the point of those lotteries for a charity is usually to make money, and they want to attract more people into the contest so that the amounts that are paid in tend to be smaller than the amount of the prize. And of course, that only happens if people who buy lottery tickets aren't thinking like this. They aren't thinking rationally. They aren't thinking in this more sophisticated way that we've been assuming for the last two chapters. Okay, and people do think in this less sophisticated, less rational way, and so there actually are quite a few people buying lottery tickets, even though financially they don't make much sense. Okay, and as I said, that's one of the limitations of the material we covered in these last two chapters, chapters 8 and 9, and that we're basically assuming that that the average consumer, the average firm, is aware of how to do these sorts of calculations. They know how to calculate expected values, roughly what the odds are, and they know how to do present discounted values when they're thinking about long-term flows of costs or benefits. That's not always true, but the intuitions that people have are often at least roughly compatible with these more sophisticated methods, and more sophisticated traders, of course, will use these sorts of techniques and more sophisticated ones than the ones we have time to do in this block of material. Right. Our aim here is just to introduce the ideas, have them in the back of your mind, so you become more sophisticated choosers yourself, and also understand how more sophisticated parts of the market operate, and why firms that look like they're going prosperous activities are often just closed up in a way that seems a bit surprising. And as I mentioned with that bookstore example, sometimes when you, after you've made your bet, in a sense, undertaken the Knightian risk, the returns aren't as high as you were hoping for, and at some point it pays just to give up and cash out of the investment and take the money and invest it in the next project. So with that, I'll stop this lecture, and that's the end of the third recorded lecture. I recorded the second and third one first because that material is independent of the expected value material we're going through in class this week. That is before you're looking at this tape, and I will take the last one of those after I know a little bit about how those lectures are going in class, probably on Wednesday. So take care. I hope you enjoyed this, and again, remember to take notes. Remember, you can kind of replay it. You can stop, take screenshots, and so forth. And I'll try to add these spreadsheet results to the notes of this chapter, so you have a few more numbers to look at if you're interested in how these numbers work out for college degrees and different markups or increases in one's annual income. So thank you. See you later. Bye.